Whole life insurance is a commitment. It's you raising your hand and saying, I want protection that doesn't expire. I want guarantees I can understand. And I want to build an asset inside that protection. And let's be real about it right up front. That kind of guarantee costs money. Usually a lot more than people expect when they first hear the words, life insurance. But for the right person, in the right situation, that higher price isn't a mistake. It's the point. Welcome to Wiseside Life and Legacy. I'm Nakel Nakima, and this is episode 10, Whole Life Deep Dive, Mechanics, Tax Advantages, and When It Makes Sense. Last week, we zoomed out and looked at the broad world of permanent insurance. Today we're doing the opposite. We're zooming all the way in on whole life insurance. We're going to break down how it's built, what your premium is really doing, what cash value is and how you actually use it, where the tax advantages come from, and most importantly, who this product is truly designed for. By the end of this episode, you should be able to answer one question with confidence: does whole life make sense for me, or am I better off somewhere else? Whole life has been around for generations. It's the classic permanent insurance product. The one your grandparents might have had. The one you've heard about in family conversations where somebody says, yeah, we've had that policy forever. But here's the problem. Whole life is one of the most misunderstood financial products out there. Some people treat it like a scam. Other people treat it like a secret wealth hack. The truth is more practical than either extreme. Whole life is a tool. A very specific tool. And you don't buy a tool just because it exists. You buy it because you have the job it was made to do. So let's build from the ground up. What are you actually buying when you buy whole life? You are buying a contract with an insurance company. The contract basically says this: as long as you keep paying the premium, the company will keep your death benefit in force for your entire life. Not 20 years. Not until age 65. For life. And at the same time, part of what you pay is building up a cash value inside the policy, kind of like a built-in savings component. That cash value grows at a guaranteed rate set by the contract. And when you die, your beneficiaries receive the death benefit. Now here's the big headline of whole life: it's designed to be predictable. No investment menus. No choosing funds. No tracking the market. No guessing whether the policy will perform. You pay a set premium. The death benefit is defined. The cash value grows in a defined way. It's meant to be boring. And for certain people, boring is exactly what they want. That's very different from other forms of permanent insurance, like universal life or variable universal life, where the premium flexibility and cash value growth can shift based on moving parts. Whole life locks things in. That lock is both the advantage and the reason it's expensive. Let's put some numbers to it so this doesn't stay theoretical. Meet David Carter. David is 38 years old and wants $500,000 of whole life coverage. Let's say his premium comes out to around $900 a month, or $10,800 a year. With whole life, that payment is designed to stay the same. David isn't paying one price in his 30s and a higher price in his 60s. He locks in a premium, and it stays level as long as the policy is structured that way and he keeps it active. Now the obvious question is, where does that $900 actually go? In simple terms, the premium is split. One portion covers the true cost of the insurance, the company's expenses, and the way the policy is distributed and serviced. Another portion goes into the policy's cash value. So using rough numbers just to illustrate, maybe about $300 of David's monthly premium is going toward costs and the insurance side of the equation, and maybe about $600 a month is building cash value. Real policies vary, and early years can look different than later years. But structurally, that's what's happening: some is cost, some is asset building. That's the core trade. You're paying a higher premium in exchange for lifetime coverage and an internal asset that grows steadily. Now let's focus on the part that makes people lean in: cash value. Cash value is the savings-like account inside the whole life policy. It's real value, it builds over time, and it is one of the reasons people use whole life for more than just insurance. If David is effectively putting around $600 a month toward cash value, then in a perfect, simplified world you'd say, okay, that's $7,200 after a year. In the real world, it won't be perfectly linear because policies have internal charges and the early years often build slower. But the point is, as time passes, cash value accumulates. So you might see a pattern like this: after several years, cash value begins to feel meaningful. After a decade, it can become substantial. And the growth is tied to guaranteed rates in the contract, often modest, think low single digits. Not stock market returns. Not get-rich returns. Steady, contract-based growth. And that brings us to the practical question: if cash value belongs to you, how do you actually use it? There are three main ways people access cash value: policy loans, withdrawals, and surrendering the policy. First, policy loans. This is the most common approach because it's typically the most tax-friendly. Here's what's happening: you're not taking the cash value out like you'd withdraw from a bank account, at least not in the same tax sense. Instead, you're borrowing against the policy, using the cash value as collateral. The insurance company lends you money, usually at an interest rate that might land somewhere around 5 to 7% depending on the policy and the environment. You can pay it back on your own schedule in many cases, but you are accruing interest. And if you pass away while a loan is outstanding, the remaining loan balance is simply deducted from the death benefit before it's paid to your beneficiaries. The big reason people like policy loans is that loans generally are not treated as taxable income. You're borrowing, not selling. No taxable sale, no immediate income tax event in most typical structures as long as the policy stays in force and doesn't collapse. Second option, withdrawals. A withdrawal is exactly what it sounds like: you take money out of the cash value. The catch is taxes. If you withdraw more than what you've paid into the policy as premiums, that gain portion can be taxable. Policies also have rules around how much you can withdraw and how it affects the structure of the policy moving forward. Third option, surrender. Surrendering the policy means you're ending it. You give the policy back, you walk away from the coverage, and you receive the surrender value, which is typically closely tied to cash value minus any surrender charges and outstanding loans. If you surrender with gains, those gains can be taxable. And, of course, you no longer have the death benefit. Most long-term whole life owners who want access without blowing up the plan tend to use policy loans. But it has to be managed. This is one of those situations where, it's available, doesn't mean, take as much as you want, whenever you want, forever. You want to keep the policy healthy. Now let's talk about the part that really drives whole life's value proposition for certain households: taxes. There are three major tax advantages people point to with whole life insurance. Number 1, the death benefit is generally income tax-free. When David dies, if his death benefit is $500,000, the beneficiaries typically receive that money without federal income tax. That's a foundational feature of life insurance in the U.S. Number 2, cash value growth is tax-deferred. While the policy remains in force, the growth inside the cash value is not usually taxed year by year the way a taxable brokerage account might be. You're not getting a yearly 1099 because your cash value increased. Number 3, policy loans are generally tax-free. Again, because it's structured as a loan, not a taxable distribution, you're typically not triggering income tax at the moment you borrow. So you get this trio: income tax-free death benefit, tax-deferred growth, and potentially tax-free access through loans. Now I want to be clear, tax-efficient does not automatically mean best. It means useful, especially when someone has higher income, higher net worth, or specific planning needs, and they are already maxing out more traditional vehicles. For many middle-income families, the tax benefits may not overcome the cost. If you're comparing whole life to buying term insurance and investing the difference, a disciplined investor might do better by keeping insurance and investing separate, even after taxes, because the growth expectations are different. But if you're not comparing it to reality, if you're comparing it to an idealized version of yourself who always invests the difference perfectly, then the comparison can be misleading. Because our lives aren't spreadsheets. They're behavior. So let's make this more real with scenarios. I'm going to walk you through 3 situations, one focused on forced savings and legacy, one centered on retirement flexibility, and one that's about estate planning for higher net worth. Scenario 1, Forced savings with legacy intent. Meet Susan. Susan is 42. She earns about $130,000 a year. She's married, 2 kids, and household income is around $230,000. They're doing fine. Not private jet fine, but stable, strong, responsible. Susan saves, but she doesn't love investing. She doesn't want to manage a portfolio. She doesn't want to feel like she's gambling. And she knows something important about herself: if she buys term insurance and tells herself she'll invest the difference each month, she probably won't follow through consistently. Life happens. The money gets spent. The plan gets delayed. Susan also thinks about legacy. Not just replacing income if something happens tomorrow, but leaving something behind later, a foundation for her kids. So Susan buys a whole life policy, say $250,000 of coverage, for around $500 a month. Again, numbers will vary, but this is a workable illustration. For Susan, $500 a month is meaningful. She notices it. But it's within her ability to pay, and she likes that it's a structured commitment. Inside that $500, part covers the insurance costs and part builds cash value. Maybe it's something like $300 toward costs and $200 toward the cash value side early on. That cash value grows steadily. Over decades, it can turn into a substantial pool of value. After 20 years, Susan might see something like tens of thousands in cash value. After 30 years, perhaps well into 6 figures depending on the policy's guarantees and how it's structured. And when she dies later in life, her beneficiaries receive the death benefit. The policy has served 2 jobs: permanent protection and an enforced, structured savings path that Susan actually sticks with. In Susan's case, whole life makes sense less because it's mathematically optimal on paper, and more because it matches her behavior. It turns "I should save" into "I am saving." Scenario 2, Accessing cash value in retirement. Meet Robert. Robert is 55. He purchased whole life when he was 35 and has been paying into it for about 20 years. The death benefit is $500,000, and his premium has stayed level, say around $500 a month in this example. Over those 2 decades, Robert has built meaningful cash value. Let's say he's sitting at around $120,000 in cash value. Now, Robert's life has changed. The kids are grown. The mortgage is gone. His retirement accounts are in decent shape. He doesn't necessarily need a big term policy to protect young dependents anymore. But retirement isn't always smooth and predictable. Maybe Robert retires a little early. Maybe he wants to travel while he's healthy enough to enjoy it. Maybe there's a grandchild he wants to help with education costs. Not a crisis, more like a lifestyle choice. Robert takes a policy loan. He borrows $50,000 at about 6% interest. He gets the money without a long underwriting process and without selling investments at the wrong time. And typically, that loan isn't treated as taxable income. He uses the money for his goals, then pays the loan back over time. If he dies with a balance still outstanding, that balance reduces the death benefit. So if he still owed, say, $20,000 at the end, his beneficiaries receive $500,000 minus $20,000. The policy still does its job, and Robert got retirement flexibility. In Robert's case, whole life becomes a supplemental financial tool. Not the centerpiece of retirement, but a source of liquidity and optionality. Scenario 3, Estate planning and higher net worth. Meet Patricia. Patricia is a successful business owner. Her net worth is around $2 million, spread across a business, real estate, and investments. The problem Patricia is worried about isn't, will my family be okay next month if something happens? The problem is, when I die, will taxes or other costs force my heirs to sell assets at the wrong time just to raise cash? For families with a business or real estate holdings, liquidity can be the real enemy. You can be wealthy on paper and still have a hard time producing cash quickly without destroying value. Patricia buys a large whole life policy, say $1 million in death benefit. The premium might be around $3,000 a month in our example, high, yes, but within her affordability. When Patricia dies, her beneficiaries receive that $1 million generally income tax-free. That money can create instant liquidity to handle estate-related obligations, taxes, settlement costs, debt payoff, equalizing inheritances, whatever the estate needs. And the important part is this: her heirs may not have to sell the business or liquidate real estate under pressure. For Patricia, whole life is not about forced savings. It's not about retirement income. It's about strategic liquidity and preserving assets across generations. So after those scenarios, here's the big practical question: who should actually buy whole life? Let me be direct and make it simple. Whole life is worth considering if you want lifetime coverage, not a temporary policy that ends after a term. If you value guarantees and predictability and you don't want moving parts. If you want to build an asset inside the policy that you may be able to access later. If you're in a higher tax situation where tax efficiency actually moves the needle. If you have estate planning needs and you need liquidity at death. Or if you know that without structure, you won't consistently invest and save on your own. On the other hand, whole life is usually a bad fit if you only need coverage for a limited window, like while kids are young or while a mortgage is large. It's usually a bad fit if the premium strains your budget. It's also often unnecessary if you're a disciplined investor who will absolutely buy term insurance and invest the difference consistently for decades. And if what you want is maximum growth potential, whole life's conservative, guarantee-based growth may feel underwhelming. Whole life isn't the best product. It isn't the worst product. It's the right product in the right situation. And it's the wrong product when it's used as a one-size-fits-all solution. Before we close, I want to clear up a few common misconceptions that keep people either buying whole life for the wrong reason or rejecting it without understanding it. Misconception number 1, whole life is an investment. It's not, at least not in the way people mean when they say investment. Whole life is insurance first, with a built-in savings component. The growth is typically modest. You're not buying it to beat the market. You're buying it to create guaranteed protection and steady internal value with certain tax features. Misconception number 2, the cash value will pay the premiums forever. Sometimes that can happen under certain structures and under certain conditions, especially later in the policy's life. But it's not something you should assume as a guarantee unless your contract explicitly guarantees it in the way it's illustrated. Policy performance, loans, withdrawals, and timing all matter. The safest approach is, treat premium payments as a real commitment, not a hope that the policy will magically self-fund early. Misconception number 3, all whole life policies are basically the same. They're not. Companies differ. Policy features differ. Guarantees differ. Costs differ. The way cash value develops can differ. Even the way policy loans are treated can differ. So if you're exploring whole life, don't just listen to one pitch and assume that's the whole market. Compare options carefully. Here's what I want you to take away today. Whole life insurance is straightforward in concept but significant in cost. You're paying for lifetime protection, predictability, and the ability to build cash value inside the policy. For some people, those guarantees and that structured savings element are exactly what they need. For others, term insurance plus disciplined investing is the smarter route. Your action step this week is simple: if you're thinking about whole life, don't buy it based on vibes. Get quotes and illustrations from at least 3 insurers. Compare the premium, yes, but also compare the guaranteed cash value projections and the guarantees in writing. And talk to an independent broker if you can, not just someone who represents one company. I'm Nakel Nakima. This has been Wiseside Life and Legacy. Educate. Empower. Protect your legacy. Next week, we'll continue the permanent insurance series with a universal life deep dive.